Hey everyone! Ever thought there might be more investing opportunities beyond domestic markets? Today, we're diving into the world of international index funds and unveiling the tremendous returns of Europe's magnificent 47. Before we get started, a quick disclaimer: this is not investment advice. Every case is different, and we are not licensed financial professionals. International index funds are investment funds that track the performance of a specific group of stocks or bonds from countries outside your home market. For example, if you're in the US, an international index fund might include companies from Europe, Asia, or emerging markets. These funds offer a simple way to gain exposure to foreign economies without having to pick individual stocks, making them a popular choice for diversification. By investing internationally, you spread your risk across different economies. If one country or region struggles, another might thrive, helping balance your portfolio. Many of the world's fastest-growing economies, such as India or Brazil, are outside the US, and international index funds allow you to participate in that growth. Additionally, international markets sometimes offer lower valuations compared to the US, potentially leading to better long-term returns. How much of your portfolio should be in international index funds? While there's no one-size-fits-all answer, many financial experts recommend allocating between 20 to 40% of your stock portfolio to international investments. Your allocation should depend on your investment goals, risk tolerance, and time horizon. Some of these international stocks have seen tremendous growth these past few years. The Magnificent 47, a subgroup of the Stoxx 600 index, a European index, has delivered 100% returns since 2022. If you want to learn more about the Magnificent 47, be sure to check out our dedicated video on the topic.